Last month, two people applied for mortgages on the exact same day. Same lender, same $400,000 house, same down payment, same income of $72,000 per year. Let's call them Sarah and Marcus. Sarah's credit score, 628. Marcus's credit score, 631. Basically identical. The loan officer gave them both the same news. You're approved, but your rate will be 7.2% based on your credit profile. On a $320,000 loan over 30 years, that's a total payment of $784,000. Of that, $464,000 is pure interest. For the same $400 house, Sarah signed the paperwork that afternoon, locked in at 7.2%, done deal. Marcus said, "Can I have 90 days to work on my credit before we finalize this?" The loan officer, being a loan officer, said sure, but don't get your hopes up. Credit scores move like glaciers. You might squeeze out 20 points if you're lucky, maybe knock off 0.1% on your rate. Not worth the wait in his professional opinion. Marcus left without signing. Sarah moved into her house 60 days later. 7.2% interest rate. Monthly payment, $2,177. She felt good about it. Homeowner. American dream achieved. Marcus came back 94 days later. His credit score, 748. The loan officer actually pulled his report twice because he thought there was an error. There wasn't. Marcus had gone from 631 to 748 in 3 months, a 117-point jump. His new interest rate, 6.1%. Same $320,000 loan, same 30-year term. Total payment now, $700,000. Interest, $380,000. Let me spell out what just happened. Sarah pays $464,000 in interest over 30 years. Marcus pays $380,000 in interest over 30 years. Difference, $84,000. But wait, as a dog, I know you can't just look at the price tag. You have to look at the opportunity cost. What else could you do with that money? If Marcus invested that $84,000 difference at 10% returns over those same 30 years, it would compound to $1,461,000. Same house, same down payment, same income. The only difference? Marcus spent 90 days learning something lenders desperately hope you never figure out. That's $1.46 million in wealth created from knowledge, not from working harder, not from a better job, from understanding one mechanism in the credit system that exists by design but isn't advertised because nobody profits from you knowing it. As a dog, if another dog told me I could get better treats just by borrowing someone else's reputation for 90 days, I'd ask how fast I could do it. Humans hear this and think it sounds too good to be true, so they ignore it and pay $464,000 in interest instead. Today I'm breaking down exactly what Marcus did, how the loophole works, and why lenders would rather light money on fire than explain this to you. Let's start with why the conventional advice keeps you trapped longer than necessary. Here's what every financial advisor, bank, and credit counselor will tell you about building credit. Pay your bills on time. Keep your balances low. Don't open too many accounts, and wait. Wait years. Wait decades. Let your credit history age like fine wine. Eventually, maybe when you're 40, you'll have an excellent score. This advice isn't wrong, it's just incomplete in a way that makes lenders a fortune. Let me show you the math on why slow and steady costs you so much money. Meet Alex. Started building credit at age 22. Got a secured credit card. Paid on time every month. Did everything right. By age 30, Alex has a 680 credit score. Good credit according to the scale. Meet Jordan. Same age. Started building credit the same way. But at age 24, Jordan learned about the loophole. At age 30, Jordan has a 760 credit score. Excellent credit. Now both apply for that same $320,000 mortgage. Alex, 680 score, gets quoted 6.8% interest. Total interest over 30 years, $427,000. Jordan, 760 score, gets quoted 5.8% interest. Total interest over 30 years, $348,000. Difference, $79,000 in interest paid. But it doesn't stop there. Car loans. Alex pays 8.5% on a $30,000 car loan. Jordan pays 5.2%. Over 5 years, Alex pays $3,960 more in interest. Credit cards. Alex's cards charge 21.99% APR. Jordan's charge 15.99% APR. If they each carry an average $4,000 balance, which they shouldn't, but let's be realistic, Alex pays $880 per year in interest, while Jordan pays $640. Over 10 years, that's $2,400 more. Insurance. In states where credit scores affect insurance rates, Alex pays roughly $400 per year more for auto and home insurance. Over 30 years, $12,000. Added up, $79,000 plus $3,960 plus $2,400 plus $12,000 equals $97,360. Alex and Jordan made the exact same financial decisions except one. Jordan learned about authorized user trade lines at age 24. That one piece of knowledge created a $97,360 wealth gap. And if Jordan invested even half of those savings at 10% returns, it compounds to $847,000 over 30 years. This is why lenders love the build credit slowly narrative. Every year you spend in the good category instead of excellent makes them money. Your 680 score is more profitable than your 760 score. They have zero incentive to help you escape that category quickly. In fact, they have massive incentive to keep you there as long as possible. As a dog, I've noticed that humans are really bad at recognizing when someone is profiting from their ignorance. If I noticed the treat jar was placed just out of reach on purpose so I'd have to beg longer, I'd knock it over. Humans just keep begging. So, what's the loophole? Here's what Marcus learned that Sarah didn't. Your credit score is calculated using 5 main factors. 1. Payment history, 35%. Do you pay on time? 2. Credit utilization, 30%. How much of your available credit are you using? 3. Length of credit history, 15%. How old are your accounts? 4. Credit mix, 10%. Do you have different types of credit? 5. New credit, 10%. Have you opened accounts recently? Most people focus on payment history and utilization. Those are important, but here's what nobody tells you about length of credit history. You don't have to wait 10 years to have 10 years of credit history. When someone adds you as an authorized user on their credit card, that entire account, including its age, payment history, and credit limit, appears on your credit report as if you'd been part of it from day one. Read that again, because this is where the magic happens. If your mom has a credit card she opened 18 years ago with perfect payment history and a $25,000 credit limit, and she adds you as an authorized user today, your credit report will show an 18-year-old account with perfect payment history and a $25,000 limit. Immediately. Your average account age could jump from 3 years to 12 years overnight. Your total available credit could triple. Your payment history could go from 3 years of data to 18 years of data. This is exactly what Marcus did. Marcus had 2 credit cards of his own. Card 1, opened 4 years ago, $3,500 limit. Card 2, opened 2 years ago, $5,000 limit. Average account age, 3 years. Total credit limit, $8,500. His mom had 3 credit cards. Card 1, opened 22 years ago, $18,000 limit, 0% utilization, perfect payment history. Card 2, opened 15 years ago, $12,000 limit, 2% utilization, perfect payment history. Card 3, opened 11 years ago, $20,000 limit, 1% utilization, perfect payment history. Marcus's mom added him as an authorized user on all 3 cards. She didn't give him physical cards. She didn't give him access to the accounts. She just added his name. Within 2 billing cycles, about 60 days, Marcus's credit report showed 5 total accounts, his 2 plus her 3. Average account age, 13.6 years, up from 3 years. Oldest account, 22 years, up from 4 years. Total credit limit, $58,500, up from $8,500. Payment history, 16 years of perfect payments, up from 4 years. His credit score jumped from 631 to 748 in 60 days. The system allows this because authorized user reporting was originally designed to help spouses build credit. One partner manages all the finances and opens accounts in their name. The other partner, often a stay-at-home parent, would have no credit history despite being part of a financially responsible household. Authorized user status solved this problem by letting the financially active partner share their credit history. Over time, people realized the mechanism wasn't limited to spouses. Parents could help their kids. Siblings could help each other. Anyone could help anyone, at least mechanically. And here's the kicker. This is completely legal. FICO and VantageScore, the 2 main credit scoring models, explicitly include authorized user accounts in their calculations. Credit bureaus recognize these accounts as legitimate. Lenders know about this. Mortgage brokers know about this. Credit repair companies charge thousands of dollars to set this up for people. But they don't advertise it because there's no profit in helping you escape high-interest purgatory faster. As a dog, this makes perfect sense to me. If I figure out that I can get treats faster by sitting near the responsible dog who always gets treats, I'm going to sit near that dog. The treat giver doesn't care which dog I am. They just see a dog with good behavior history. Humans overthink this.
Marcus didn't stop with authorized users. He learned a second trick that most people completely miss: credit utilization. How much of your available credit you're using accounts for 30% of your score. Conventional wisdom says keep it under 30%. Better advice says keep it under 10%. The actual optimal target is 1 to 3%. But here's what nobody tells you. Utilization is measured based on your statement closing date, not your payment due date. Let me show you why this matters. Sarah's credit card behavior. $5,000 credit limit. Charges $3,000 per month for normal expenses. Pays the full $3,000 balance every month by the due date. Never pays interest. Thinks she's doing everything right. Her statement closes on the 15th of each month, showing a $3,000 balance. That's 60% utilization. Even though she pays it off in full, the credit bureaus see 60% utilization when the data gets reported. Her score is being penalized even though she's technically using credit responsibly. Marcus's credit card behavior after learning the loophole. $5,000 credit limit. Charges $3,000 per month for normal expenses. Pays down $2,900 of the balance before the statement closes on the 15th. Statement reports only $100 balance. Pays the remaining $100 after statement closes. His reported utilization? 2%. Same spending, same responsible payment behavior, completely different score impact. Sarah shows 60% utilization every single month. Marcus shows 2% utilization. This one change added 30 to 40 points to Marcus's score within 1 billing cycle. The trick is simple. Pay before the statement close date, not just before the due date. Most people don't even know when their statement closes. They just know when the payment is due. Those are 2 different dates, usually about 25 days apart. Find your statement closing date. It's on your last statement or in your account settings. Set a calendar reminder for 2 days before that date. Pay your balance down to under $100 before the statement closes. Your credit report will show near zero utilization. Your score will jump. You didn't change your spending at all.
You just changed the timing of one payment. As a dog, if I learned that I get more treats by begging at 3 p.m. instead of 4 p.m., I'd start begging at 3 p.m. It's not complicated. But humans will keep begging at 4 p.m. for years because that's when they've always done it. Here's a trick Marcus used that costs you nothing and takes 5 minutes. Utilization is a ratio, balance divided by credit limit. You can improve it 2 ways. 1, reduce the balance, the numerator. 2, increase the limit, the denominator. Most people only focus on number 1. They ignore number 2 completely. Many credit card issuers let you request credit limit increases with zero hard inquiry on your credit report. American Express, Chase, Capital One, they'll often approve significant increases using a soft pull that doesn't affect your score. Marcus's strategy. He logged into each of his credit cards and requested limit increases every 6 months. Card 1 started at $3,500 limit. After 3 requests over 18 months, $10,000 limit. Card 2 started at $5,000 limit. After 3 requests over 18 months, $12,000 limit. Total limits went from $8,500 to $22,000. If Marcus carries a $2,000 balance, which he doesn't, but let's say he does, at $8,500 limits, 23.5% utilization. At $22,000 limits, 9% utilization. Same balance, different ratio, better score. This also gave him breathing room. When those 3 authorized user accounts appeared with $50,000 in combined limits, his total available credit jumped to $72,000. Even if he charged $3,000 for monthly expenses, that's only 4.2% utilization. The banks don't advertise that you can just ask for more credit. They prefer you stay at limits that keep your utilization in the penalty zone, where you're charged higher interest rates but still make payments. As a dog, if the treat jar had an unlimited supply and all I had to do was ask for a bigger jar, I'd ask every single day. Humans somehow think asking makes them look desperate. Meanwhile, they're paying 24% interest because their limit is too low. Okay, enough theory. Here's the actual playbook Marcus followed. You can copy this exactly. Step 1. Find the right authorized user account. You need someone with perfect payment history, or close to it. Account age of 10 plus years. Older is better. High credit limit, $10,000 plus. Low utilization, under 10%. Check mark. Willingness to add you without giving you card access. This is usually a parent, grandparent, or very close family friend. Do not use an account with any late payments in the last 7 years. High utilization, over 30%. Recent account, under 5 years old. A bad account will hurt you, not help you. Step 2. Get added as an authorized user. The primary account holder logs into their credit card account online or calls the issuer. They add you as an authorized user using your name, date of birth, and social security number. They do not need to give you a physical card. They do not need to give you account access. This is purely a reporting mechanism. Most major issuers, American Express, Chase, Bank of America, Capital One, Discover, report authorized users to all 3 credit bureaus. Step 3. Wait 1 to 2 billing cycles. The account will appear on your credit report within 30 to 60 days. You can check for free at annualcreditreport.com. Once it appears, your score will update. Step 4. Optimize your utilization timing. Find your statement closing date for each card. Pay balances down to under $100 before that date, not before the due date, before the statement closes. Do this every single month. Set recurring calendar reminders. Step 5. Request credit limit increases. Log into each of your credit cards. Look for Request Credit Limit Increase in Account Settings. Request an increase every 6 months. Most issuers use soft pulls, which don't hurt your score. American Express is particularly generous with increases. Step 6. Monitor your score. Use Credit Karma, Experian, or your credit card's free score tool. Watch your score climb over 2 to 3 months. Step 7. Apply for the mortgage/loan when your score peaks. Once you hit your target score, usually 740 plus for best mortgage rates, apply immediately. Don't wait months. Scores fluctuate. That's it. That's the whole strategy. Marcus did exactly this. 631 to 748 in 94 days. Saved $84,000 in interest. Created $1.46 million in compound wealth difference over 30 years. As a dog, I have to say, humans make everything so complicated. This is like teaching a puppy to sit. You show them once, they do it, they get a treat. But humans need 47 blog posts, 3 YouTube videos, and a financial advisor charging $200 per hour to tell them the exact same thing I just told you for free. Now, let me show you where people screw this up, because Marcus almost made these mistakes too. Mistake number 1, choosing a bad authorized user account. Marcus's uncle offered to add him to his 20-year-old credit card. Sounded perfect, until Marcus asked about payment history. The uncle had missed 3 payments in the last 5 years. If Marcus had been added to that account, those missed payments would have appeared on his report too. His score would have dropped, not increased. Always vet the account first. Ask for full payment history, current balance and credit limit, utilization percentage, account age. If any red flags appear, decline politely. Mistake number 2, applying for new credit during optimization. Marcus's friend told him to open a new credit card to boost his credit mix. Terrible advice. Every hard inquiry drops your score 5 to 10 points temporarily. Every new account lowers your average account age. Marcus was trying to raise his score, not sabotage it. Rule: do not open new credit accounts while optimizing your score. Wait until after you've locked in your mortgage rate. Mistake number 3, inconsistent utilization timing. Marcus paid before his statement closing date for 2 months, saw his score jump 20 points, got excited, and forgot to do it the 3rd month. His statement closed with a $4,200 balance on a $5,000 limit, 84% utilization. His score dropped 35 points in 1 month. He learned the hard way. Consistency matters. Set automatic calendar reminders. Pay before statement close every month, not just when you remember. Mistake number 4, waiting too long to apply. Credit scores fluctuate. Marcus hit 748 in month 3. He thought, maybe I can get it even higher if I wait another month. Month 4, his score dropped to 731 because one of his authorized user accounts had a slight utilization increase that month. His mom bought a plane ticket. He locked in his mortgage at 731, which got him 6.3% instead of the 6.1% he could have gotten at 748. That 0.2% difference cost him $11,000 over 30 years. Rule: when you hit your target score, act fast. Don't try to squeeze out another 10 points. Lock in your rate while it's high. Mistake number 5, not removing yourself when appropriate. If you're added as an authorized user just to boost your score for a mortgage, you can be removed after closing. The account will eventually fall off your report, but by then you've already locked in your rate for 30 years. Some people stay on indefinitely, which is fine, unless the primary account holder's behavior changes. If they start missing payments or maxing out the card, your score will suffer. Monitor the account quarterly. If things go south, ask to be removed immediately. As a dog, I have learned that the best way to avoid mistakes is to watch another dog make them first. Marcus made some of these mistakes, so you don't have to. You're welcome. Here's what you need to understand about credit scores that changes everything. The credit scoring system wasn't designed to help you. It was designed to help lenders decide how much to charge you. The system reveals certain information and hides other information in ways that serve banks, not consumers. Lenders don't explain authorized user trade lines because it helps you escape their high-interest products faster. They don't teach you about utilization timing because complexity keeps you dependent on credit monitoring services they sell. They profit from you believing that credit improvement is slow, mysterious, and requires professional help. The reality? Credit scoring follows mechanical rules. Those rules are knowable. Once you know them, you can optimize them. Sarah paid $464,000 in mortgage interest because she didn't know the rules. Marcus paid $380,000 in mortgage interest because he spent 90 days learning them. $84,000 difference. Same house, same income, different knowledge. That $84,000 invested at 10% over 30 years compounds to $1,461,000. The loophole isn't hidden because it's illegal or unethical. It's hidden because lenders profit from your ignorance. Now you're not ignorant anymore. The next time someone tells you credit scores take years to build, you'll know they're technically right, but practically wrong. You'll know there's a faster path. You'll know that authorized user trade lines, utilization timing, and credit limit increases can compress years of slow progress into 90 days of strategic action. And you'll know that the financial industry would prefer you never learned any of this. As a dog, I can tell you with absolute certainty, the system has rules. Learn the rules. Use the rules. Get your treats faster. Don't sit there waiting for treats to magically appear when you could just borrow the reputation of the dog who's been getting treats for 18 years. That's the strategy. That's the loophole. That's how Marcus saved $215,000. Now, go do the same thing.